Imagine a company, right, that just grew its revenue by massive 45%.
Which is huge.
Oh, it's massive.
Yeah.
And the stock just explodes. It surges like 26% in a single trading day.
Right. So you would think the Wall Street analysts covering this stock would be absolutely euphoric.
Exactly. Like popping champagne, upgrading their price targets across the board.
Yeah.
But instead, they are staring at the underlying data and handing out this deeply cautious, dead neutral 5 out of 10 rating.
It is honestly the ultimate market paradox. I mean, you have top-line numbers screaming that this is an unstoppable hypergrowth engine, but the underlying financial machinery is whispering a very different, much more precarious story.
Well, welcome to the deep dive. For you listening right now, our mission today is to really cut through the absolute noise of the current artificial intelligence boom.
There is so much noise right now.
So much. We're going to evaluate the reality of a highly discussed voice AI company called SoundHound AI, trading under the ticker symbol SOUN. And we are pulling all of our insights today from a really comprehensive equity research report dated today, August 18th, 2026.
And you know, this specific report is so valuable because it doesn't just regurgitate the flashy headlines.
Now, it really gets into it.
Yeah, it provides a complete X-ray of SoundHound's financial skeleton and the deeply conflicted sentiment of Wall Street analysts, plus the technical trading patterns that are just whipping this stock around right now.
So how can a company be breaking its own records, crushing growth metrics, and still leave the financial experts feeling so utterly uncommitted?
It's a great question.
Okay, let's unpack this. We have to start with the catalyst for that.
It really is a direct testament to the absolute gold rush happening in the voice AI sector right now. Enterprises are just scrambling to integrate conversational AI into their customer service, their drive thrusts, their smart devices.
And SoundHound is clearly capturing a significant chunk of that panic buying.
Exactly.
And because of this robust growth, SoundHound's management didn't just report a good quarter. They actually came out and raised their full year 2026 revenue guidance.
Yeah, they did.
They are now projecting to bring in between $230 million and $260 million for the entire year.
What's really fascinating here is the signaling mechanism behind a guidance raise.
Yeah.
You know, Wall Street analysts build incredibly complex models based on management's previous breadcrumbs.
Right.
So when a management team voluntarily steps up to the microphone and says, hey, actually, our midpoint expectation is now fundamentally higher than your estimates, it signals immense internal confidence.
They're basically saying, we have clear visibility into our upcoming contracts.
Yes.
We know the pipeline is full, so we're willing to publicly guarantee a higher floor.
Precisely. So the market didn't just buy the $61.9 million in past revenue. They bought the management team's confidence in the future.
Makes sense.
Yeah, and that is the fundamental fuel for a 26% price spike on earnings day.
But, and here's where we have to pull back the curtain a bit, top-line revenue is just the money coming in the front door. We really have to talk about what it costs to keep the lights on.
The unglamorous side of the business.
Right. In the past, people might use an analogy like a restaurant that's fully booked, but losing money because they're flying in really expensive truffles from Europe.
Right, but that doesn't really explain software.
No, not at all.
Yeah.
To me, looking at SoundHound's financials, it's less like running a restaurant and more like laying down transcontinental train tracks.
Oh, that's a good way to put it.
Like you have to spend billions blasting through mountains and laying down steel before a single paying passenger ever buys a ticket.
That is a much more accurate framework for AI. I mean, the upfront capital required for research development, compute power, it's just staggering.
Yeah.
And we see that perfectly reflected in SoundHound's profitability paradox. Despite the $61.9 million in record revenue, their GAAP net loss for the second quarter actually widened to $42.8 million.
Let's clarify GAAP for the listener really quick. That stands for Generally Accepted Accounting Principles.
Right, the strict rules.
Exactly. It means they aren't allowed to hide the ugly stuff like stock-based compensation or restructuring costs. Under those strict accounting rules, they lost almost $43 million in a single quarter.
It's a heavy burn.
And if you look at the first 6 months of 2026 combined, that net loss sits at negative $67.8 million.
Which brings us to a metric that is incredibly difficult to swallow. Their trailing 12-month net margin is a staggering negative 91.84%.
Okay, wait, let's break that down. Trailing 12-month just means we're looking at a rolling window of the last year to smooth out any seasonal bumps, right?
Correct.
But a negative 91% margin. In practical terms, does that mean for every dollar of revenue SoundHound brings in, they are spending almost $2 to get it?
Essentially, yes. For every dollar of revenue coming in, they are losing almost an entire additional dollar out the back door in operating expenses, R&D, administrative costs.
Wow.
Yeah, this is the absolute definition of growth at all costs.
Yeah.
They are aggressively buying market share and funding relentless innovation by just burning through capital.
Now, any listener hearing about a negative 91% margin is probably wondering how on earth this company is even solvent.
Naturally.
But to balance the picture, the report highlights some massive, almost counterintuitive silver linings on their balance sheet.
Yeah, they do have some runway.
They really do. They're currently sitting on $202.7 million in cash and cash equivalents.
That's a solid cushion.
Plus, their total liabilities actually fell to $177.4 million, and their stockholders' equity rose to over $490 million. But honestly, the most stunning detail to me.
The debt.
Yes, their long-term debt has been completely eliminated. It is sitting at absolute zero.
Which is wild. Zero long-term debt is an incredible defensive moat for a company burning this much cash.
Right, because it means they aren't held hostage by fluctuating interest rates or aggressive creditors.
Exactly. But we have to explain the mechanics of how a company losing $42 million a quarter can somehow have zero debt and over $200 million in the bank.
Right, the money has to come from somewhere. If they aren't borrowing it from a bank, they're getting it from Wall Street.
Exactly. They are utilizing equity dilution. They issue new shares of the company to raise capital.
Oh, yeah.
So while the balance sheet looks pristine in terms of debt, the existing shareholders are having their piece of the pie sliced thinner and thinner to fund this cash burn.
And we have to look at the velocity of that burn, too.
Yeah.
If we look at the mechanical proxy for free cash flow in the report, which is operating cash flow minus capital expenditures, they burned through roughly $60.8 million in just the first 6 months of 2026.
If we connect this to the bigger picture, software companies are judged ruthlessly on their free cash flow. That $202.7 million cash pile provides a very clean runway, but, that runway is not infinite. What is truly alarming in the data is that their operating cash burn actually accelerated compared to the previous year.
So they are spending money faster than before.
Yes, exactly.
So management knows the clock is ticking. They know they can't just rely on organic growth to eventually outpace this cash burn.
Right.
Which brings us to a massive structural wild card. They decided to buy another company.
Yeah, this is huge.
SoundHound has a pending acquisition of LivePerson, expected to close in the second half of 2026.
This is a seismic event for the company, and it really represents a massive pivot in strategy.
You're probably listening to this and wondering, if a company is already bleeding over $40 million a quarter, why on earth are they taking on the massive operational headache of integrating an entirely separate tech company?
It sounds counterintuitive.
It feels like trying to run a marathon while deciding to carry a second person on your back.
It's the ultimate gamble on strategic scale. I mean, acquiring LivePerson could theoretically grant SoundHound instant access to a massive, established customer base.
Right.
LivePerson specializes in conversational AI and messaging. So think of the chatbots and text-based AI that handle enterprise customer service. SoundHound specializes in voice AI.
Oh, so if you merge the two.
Exactly. If you merge the two, you suddenly offer an omnichannel dominance that is incredibly appealing to massive global brands. You are essentially buying your way into a larger revenue footprint to justify your own valuation.
But integrating two tech stacks is never as simple as just plugging in a USB drive. You have completely different code bases, different cloud architectures, different corporate cultures.
And that introduces severe integration risk. The report specifically flags these, quote, contingent acquisition liabilities.
What does that mean in plain English?
When you buy a company, you buy their hidden tech debt. You buy their redundant staff, their incompatible IT systems, and any future financial obligations tied to the deal. Yeah. For a company like SoundHound, which is already struggling to show operating leverage, which is just the ability to grow revenue faster than expenses, this acquisition could easily widen those reported gap losses significantly before any real mathematical synergy kicks in.
So it could be the catalyst that saves them or the anchor that drags the balance sheet completely underwater.
Absolutely.
And with all of this fundamentally chaotic data, record-breaking revenue, massive gap losses, a zero-debt balance sheet fueled by dilution, and a highly risky acquisition, we have to look at how Wall Street is attempting to price this stock.
It's a mess. The technicals and the sentiment data are a perfect mirror of the fundamental confusion we just discussed. As of the report's date, the last closing price was $7.04.
Let's give that $7.04 some historical gravity for you listening. It is down roughly 68% from its 52-week high of $22.17.
A huge drop.
Right, but at the exact same time, it is sitting almost 25% above its 52-week low. It is trapped right in the middle of a massive, violent historical swing.
And the valuation multiple the market is assigning it is still highly elevated. Like the price-to-sales ratio, or PS, is 17.7.
Just to put that in perspective, in a traditional market environment, investors might pay 2 or 3 times a company's current sales.
Exactly. Paying almost 18 times sales means investors are breaking a massive premium into the current price, purely on the belief that future sales will explode exponentially.
But despite that premium, here's where it gets really interesting. The professional analysts whose entire jobs depend on valuing this company are in complete fundamental disagreement.
There is zero consensus.
Right. There's no consensus on Wall Street. D.A. Davidson recently lowered their target to $10. Piper Sandler lowered theirs to $7, which is basically where the stock sits today.
Yeah.
But then you have Ladenburg Thalmann sitting at a $16 target and H.C. Wainwright holding a massive street-high target of $20.
A spread from $7 to $20 among major institutional analysts tells you everything you need to know about the philosophical divide regarding AI right now.
It's night and day.
It is. The analysts at $7 are looking at the negative 91% margin and the cash burn. The analysts at $20 are looking at the 45% revenue growth and the live person synergies.
And when you look at the technical chart, you can actually see this battle playing out in real time through the moving averages.
Yes, moving averages help us smooth out the daily volatility to see the actual trends. Right now, SoundHound's price of $7.04 is sitting slightly above its 20-day and 50-day moving averages, which are, hovering around $6.72.
Meaning that in the short term over the last month or two, the stock has genuine strength.
Correct. That recent earnings beat and the raised guidance injected real short-term optimism. However, the price is still sitting significantly below its 200-day moving average, which is all the way up at $8.87.
Okay.
That 200-day line represents the longer-term sentiment.
So we have a short-term pop trapped inside a long-term downward trend.
Yeah.
And what about the momentum? Like, is the stock exhausted?
Well, the report highlights the RSI, the Relative Strength Index. This is a momentum indicator plotted on a scale from 0 to 100. A stock pushing above 70 is considered overbought and due for a pullback. A stock dropping below 30 is oversold and due for a bounce. Right now, SoundHound's RSI is sitting at 59.43.
So on a scale of 0 to 100, 59 is basically dead neutral territory. The momentum isn't exhausted, but it isn't surging either. The market is just holding its breath.
It is waiting for a catalyst to break it out of this technical tug-of-war.
Which brings us to the deepest risk factor in this entire report, and really the actual mechanics behind why this stock is so incredibly volatile.
Yeah.
We've talked about the bulls forecasting $20 a share, but a massive portion of the market is actively, aggressively betting that this company will fail.
This raises an important question about market mechanics. SoundHound is currently listed among the most shorted stocks on the market.
Let's briefly explain the mechanism of short selling, just to be clear, because it completely changes how we interpret that 26% earnings spike.
Go for it.
When you short a stock, you are borrowing shares from a broker and selling them immediately at today's price. Your hope is that the price crashes, so you can buy those shares back much cheaper, return them to the broker, and pocket the difference.
Exactly. It signals deep structural pessimism. These short sellers are looking at the exact same data we are, the accelerating cash burn, the integration risks with live person, and they are placing massive bets that the valuation will ultimately collapse under its own weight.
But wait, if I'm a short seller and the stock suddenly spikes 26% on a surprise revenue beat, I am instantly underwater.
Oh yeah, very much so.
My potential losses are technically infinite because the stock's price can just keep rising forever.
Oh.
Are you saying that 26% price spike wasn't just organic excitement from buyers, but actually a mechanical short squeeze?
Yes, that is a huge part of the equation. A high short interest is, it's like pulling a rubber band back as far as it will go. The tension is all that bearish, pessimistic positioning.
Right.
But when management releases undeniably good news, like a 45% revenue jump and raised guidance, they let go of the rubber band. The short sellers panic.
They have to cover.
Exactly. They are forced to buy shares on the open market at whatever price is available just to return the shares they borrowed and stop their bleeding.
So it's forced, panicked buying. The short sellers literally become the rocket fuel for the stock's rise.
Exactly. That is the dual nature of high short interest. It proves that a large segment of the market hates the stock, but it also creates the exact conditions for violent upward price spikes on any shred of good news.
So let me push back on this bear case for a second. If you were listening to this and trying to weigh the risks, isn't the market's pessimism largely priced in at this point?
How do you mean?
Well, the stock is down almost 68% from its high. It's trading well below its 200-day moving average. Hasn't the balloon already been deflated?
That is the critical debate right now. I would argue that a significant amount of the historical speculative risk is already priced in. The market has clearly punished SoundHound for the initial irrational hype phase of the AI boom. They aren't trading at a $22 peak anymore.
But there is still risk on the table.
Immense risk. What might not be priced in is the future cost of reality. Investors right now are celebrating the top-line revenue growth, but the market hasn't fully digested the widening gap losses. If that operating cash burn accelerates again in the upcoming quarters, Wall Street will abruptly realize that a $200 million cash runway is much shorter than it appears.
And then there's the merger.
Furthermore, the market hasn't priced in any potential missteps with the LivePerson acquisition. If that deal closes and SoundHound suddenly has to report massive restructuring costs, write-downs, or lost customers during the transition, the stock will face intense, renewed downward pressure.
So what does this all mean? Let's synthesize this deep dive. The comprehensive research report we've been analyzing leaves SoundHound AI with an overall rating of 5 out of 10. A pure, dead-center neutral stance looking out over a 6 to 12-month horizon.
It is the ultimate show-me rating. The analysts are effectively saying, we see the record revenue, we acknowledge the raised guidance, and we understand the strategic vision.
Right.
But you have to show us you can scale this business without continually diluting your shareholders and lighting your balance sheet on fire.
For you listening, the report flags a few very specific, measurable turning points to watch over the coming months. First, the upcoming Q3 earnings, which should hit around November 2026.
That's a big one.
Yeah, you need to look past the top-line revenue and see if that GAAP net loss of $42.8 million starts to actually narrow.
Second, watch for the successful close of the LivePerson deal in the second half of the year. The market will be looking for actual measurable synergies. Are they effectively cross-selling voice and text AI to the same clients, or are they just absorbing new liabilities?
And technically, watch that 200-day moving average at $8.87. If the stock can break above that level and hold it as support, it might signal to the algorithmic traders that a true long-term trend reversal is underway.
Ultimately, the SoundHound story is really a microcosm of the entire artificial intelligence industry right now. We are in an era where the sheer mention of AI commands massive premium valuations and high price-to-sales multiples.
Cool.
But it leaves us with a lingering, provocative question to consider. How long will the broader market tolerate this philosophy of growth at all costs before it brutally demands actual sustained operating leverage and free cash flow from these companies? The music is still playing and the revenue is growing, but the cost of the ticket keeps going up.
A brilliant point to end on, and a perfect question to keep in mind as this entire sector evolves. Thank you for joining us on this deep dive. Keep questioning the headlines, keep digging into the underlying data, and we will catch you next time.